It's a very timely moment to take a look at the Swiss housing market, with the SNB cutting interest rates unexpectedly and UBS releasing their quarterly real estate bubble index. Matthias Holzi is one of the economists behind the report. Matthias, how dangerous would a housing bubble be to Switzerland, and does Switzerland have a history of the problem?
Well, general real estate is the biggest single asset in most economies, and it's the biggest part of household wealth. So in Switzerland, the value of real estate is about 42% of total household assets, or roughly 1.4 trillion Swiss francs, and roughly 50% of the total value, this would be then around 700 billion, is external financed. So these numbers emphasize that the movement in house prices can have a huge impact on the economy. Now, the main risk for Switzerland comes from households are holding LIBOR mortgages, which may get in trouble when interest rates increase suddenly. Now, if then households are in trouble to pay their interest payments and default, house prices will come under strong pressure, and then if subsequently banks force their customers to increase their equity capital, the defaults will become even more frequent. Directly, this hurts most of the banking sector then, and if, as it happened in most bubbles, or also in the last bubble in Switzerland, overcapacities in the housing markets have been built up, then the building industry will come under pressure for several years, as it takes just time to absorb such overcapacities. And furthermore, indirectly, naturally, consumer spending comes under pressure as well, as households are forced to save more, what may trigger an overall recession.
Your latest data shows Switzerland has a booming housing market. What does that actually mean?
As the Swiss Real Estate Bubble Index currently stands at a level of 7.65, that indicates, as you said, that we are currently in a booming housing market, and that means we have no elevated risk of no overheating currently. That would say that the opportunities are still higher than the risk in the overall market. But Switzerland is definitely edging towards a bubble, if you can say so. Currently, even though we are still in a boom market, we already have several risk regions which have a higher probability of a price correction. So if interest rates stay close to zero, demand for housing will continue to grow strongly and exceeding supply further, and therefore push prices higher. The longer interest rates stay low, the higher the risk of a correction after rates increase. Which regions are heading towards a bubble? Would Geneva be one of them? Yes, as we see that the main risk regions are Zurich and Geneva, followed by Lausanne, Pfannenstiel, Zug and Zimmerberg. These regions are characterized by high housing prices and strong price increase in the last 3 years, and are also densely populated. High price increases means between 8 and 11% on average per year in the last 3 or 5 years. But there are also other hotspots which are not necessarily a risk for Switzerland naturally. This would be many touristic regions, as also St. Moritz or Gstaad, where prices more than doubled even in the last 5 years. Does this all mean that the SNB needs tighter monetary policy? Yes, the Swiss National Bank shares these concerns basically. But due to the extremely strong Swiss franc in the moment, the SNB cannot react to those concerns and will not raise interest rates anytime soon. But the SNB mostly encourages banks to become more cautious with the granting of mortgages and tries to toughen regulations in that matter. So how much of a hike is actually needed? 2 or 3% up. Currently, affordability is even though prices increased strongly in the last years, is still a lot better now than it was 2008. And this just has to reverse. So it's still so much cheaper to buy a house than it was 4 or 5 years ago, even though prices went up 30 or more percent. Okay, thank you, Matthias. We have interviews with more of the world's leading banks and economic experts here on Dukascopy TV, so don't go anywhere. Goodbye.